On July 24th, one of the largest banks on earth is going to switch off gold for its own people. If you're an ordinary citizen in China with an account at ICBC, the biggest bank in the world by assets, your ability to trade gold through that bank simply ends. Turned off. And ICBC isn't alone. Postal Savings Bank already did it back in March. Ping An followed, then Guangfa. One of the world's largest financial systems is quietly ushering its own people out of the gold market. The official reason is to protect them. Maybe. But here's the thing that made me look closer. The same government waving its citizens away from gold is, at the exact same time, buying more physical gold than almost anyone on the planet. So, which is it? Is gold too dangerous to touch or too valuable to let go? To answer that, I had to follow a much older question, one with a number attached to it that shouldn't be possible. The United States government owns more than 8,000 tons of gold, and on its official books, it still values that gold at $42 an ounce. The real market price? Around $4,000. Now, to be fair, that $42 isn't a secret, and it isn't a scam. It's an accounting number frozen into law in 1973 that nobody ever bothered to update. But sit with how strange it is anyway. The most powerful treasury on earth carries its gold on the books at 1/100th of what the world says it's worth. It's a tiny window into a bigger truth that when it comes to gold, the official price and the real price have a long, complicated history of not matching. And a theory that's followed gold for decades says that gap is not an accident. I want to test that theory honestly, including trying to prove it wrong. Start with how paper gold even works. Imagine a warehouse. You hand it one real gold bar and it hands you back a paper receipt, a claim on your bar. Convenient, safer than hauling metal around, so you trade the receipt and you never actually come collect the bar. Now, what stops that warehouse from printing a second receipt on the same bar? A third, a 10th. As long as almost nobody shows up to collect, it can sell far more claims than it has metal. On paper, the world now thinks 10 bars exist. In reality, there's one. And if the market price is gold by how much seems to exist, all that extra paper pushes the price down. Here's the honest counter-argument, and it's a good one. Paper markets aren't automatically fraud. They provide liquidity, they let people hedge, and over time the paper price and the physical price usually track each other. Most economists will tell you the system basically works. So if the theory is right, it can't just assert suppression. It has to show up as something you can actually measure. So I went looking for evidence, and for evidence against it. If paper were quietly holding the price down, you'd expect one thing above all: the physical metal in the places that actually want it would cost more than the paper says it should, a stubborn premium that won't close, and that's exactly what you find in the East. For years, gold on the Shanghai Exchange has traded at a persistent premium over the London price. The buyers who insist on real metal, delivered, keep paying up. In silver, it's been even wilder. Physical premiums in markets like Dubai blew out dramatically this year. Now, the honest explanation, and it's a big part of the story. A lot of that premium is just taxes, import rules, and capital controls. Real, boring, documented. But sit with what that actually means. China has walled its physical gold market off from the Western paper price on purpose. The two prices don't fully connect by design, and a market you've deliberately sealed off from the outside is a market whose price you can one day set yourself. That's the first thing that kept the theory alive for me. The second is harder to wave away. If you genuinely believed the paper price was fake and the real price was higher, what would you do? You'd sell the paper and you'd buy the physical metal as fast and as quietly as you could. So, is anyone doing that? Yes, and it isn't retail traders, it's the central banks, the very institutions that print the paper currencies. They've been buying physical gold at the fastest pace ever recorded. In the first quarter of this year alone, a net 244 tons, the strongest first quarter on record. They've now bought over 200 tons in 10 of the last 11 quarters. And here's the detail that stopped me. They kept buying straight into a crash. Gold ran to an all-time high, near $5,600 in January, then fell almost 30%. Ordinary investors panic sold. The central banks kept accumulating. People who buy more of something while its price collapses aren't chasing a trade. They're acquiring a position, and a chunk of that buying was never even officially reported. The World Gold Council openly says its own figures include an estimate of undisclosed purchases. Now, undisclosed sounds sinister. But there's a mundane reason, too. A giant buyer hides its orders so it doesn't drive the price up against itself. Fair enough. But whether it's quiet or loud, the direction is identical. Acquire the metal. What were they selling to pay for it? For 50 years, the safe move was to park your surplus in US government debt, treasuries. Everyone did it. Lately, some of the biggest holders have been quietly selling that debt, trading the paper promise of the most powerful government on earth for a metal that pays them nothing at all. There's an innocent reason for that too. Sanctions fear after 2022. Simple diversification. But notice, every innocent explanation points the same direction. Trust the metal, distrust the paper. And if all of this were real, you wouldn't just see it in the numbers. You'd see the gold physically leave. It is. For several months, gold has quietly been the #1 export leaving the United States out of more than 1,000 categories. It's flowing east. And the strangest part, China told us this was the plan 12 years ago. Back in 2014, the head of the Shanghai Gold Exchange stood in front of the Western gold establishment in London and said, almost politely, Shanghai Gold will change the current situation of consumption in the East, priced in the West. Translation: today you set the price and we just buy. That's about to flip. In 2014, it sounded like ambition. In 2026, it's being built. Here's the build. China is standing up its own gold market, one designed so the house can't quietly print claims. That's the real reason the retail paper trading is going dark at home. And in the same stretch, they're switching on the other half, a new gold settlement system run through Hong Kong, wired to the Shanghai Gold Exchange. The logic is clean. Shanghai is the vault and the price, built on physical delivery. So when metal trades, real metal actually has to move. That forces the price to reflect real supply and demand instead of a stack of paper. But China's borders make it hard for outsiders to get in. So Hong Kong becomes the front door the rest of the world can trade through. How serious are they? Hong Kong is expanding its gold vault capacity from around 200 tons toward 2,000. A tenfold jump phased in over the next several years. You don't build a vault that size to store paper. You build it to settle in metal. And that's the end game. If China can price the world's most trusted money in real gold and settle it in their currency, the yuan gets something it has never had. An anchor, not a gold standard, but something solid behind it that no government can print. That is how you challenge the dollar without ever firing a shot. So what does the United States do about it? Remember that gold on America's books, frozen at $42? With a single stroke of a pen, the Treasury could revalue it to the market price, and nearly $1 trillion would appear on its balance sheet. No new debt, no printing, just an accounting entry 50 years overdue. And this part isn't fringe. The Federal Reserve has published research on the idea. An economist named Judy Shelton has proposed a 50-year Treasury bond you could redeem in either dollars or physical gold, which would quietly back the dollar with metal. The mirror image of China's move. A few people even speculated it might be unveiled around America's 250th birthday, this past July 4th. Well, that date has come and gone, no revaluation. And that's exactly why we draw the honest line right here, because this is where a lot of videos lie to you. The forced gold trading shutdown, the record central bank buying, the undisclosed purchases, gold leaving the United States, China's new settlement system, those are facts. Documented. The idea that America would revalue its gold on the 4th of July, that was speculation, and the day passed with nothing. In fact, the current Treasury Secretary talked about monetizing the asset side of the balance sheet, and then said plainly, we are not going to revalue gold, pointing instead to things like federal land and energy. So the revaluation lives with researchers and outside economists, not as official policy. Anyone selling you certainty here is selling you something. So what's the honest takeaway? Whether or not the word manipulation is ever proven, the most sophisticated money on earth is behaving as if the real price of gold is higher than the paper says, and quietly repositioning for it. And here's the one thing that actually touches your life. For this to matter to you, gold doesn't even have to go up. The dollar just has to go down against everything you buy. Same result measured from the other side. You don't need to buy gold tonight. You just need to understand that the people who move first are the ones who print the money, and the rest of us usually find out last. So watch the vaults, not the headlines, because the real story of money is never announced. It's just moved, and by the time it's announced, the move is already over. So keep your eyes on the quiet things, the book values, the vault capacities, the flows that never make the news. Because that's where the next chapter of this story is being written right now. If this changed the way you see the price of things, subscribe and stay close. I'll keep following the money, and I'll see you in the next one.